Andrea, with all the focus on the U.S. economy and people watching Fed Chairman Powell, are they missing opportunities in foreign bonds and emerging markets?
Absolutely. When you look at the diverging growth rates between developed markets and emerging markets, we're starting to see the skew move back towards emerging markets. So when you think about your next dollar spent across portfolios, it's certainly making the case that it should be considering emerging market debt at this point.
And emerging markets tend to get hit really hard by inflation. But if inflation, as they say it is subsiding here in the U.S., shouldn't that also be a boon for emerging markets?
You're already seeing it subside there. It really came to a boil faster in emerging markets in 2021, much earlier than in developed markets, and you're seeing it come off that boil faster. So as a result, you're seeing much healthier opportunities across the emerging market landscape at this point in time as compared to developed markets.
All right, I've been lumping them all together, but there are a lot of different emerging markets, each with their own characteristics. So, for example, you have Eastern Europe, where there's a lot going on. You have Asia, where there's also a lot going on. Which ones are the best right now?
Well, I think on the back of China's reopening being faster than most investors anticipated, we like many opportunities that have China-related export links. So we're going to look to sub-Saharan Africa, we're going to look to Latin America. A lot of the commodity exporters are really going to benefit as China continues to grow.
That said, there is a lot of geopolitical unease between the United States and China. How will that factor into things?
Well, I think the most important factor right now is we're not seeing that geopolitical risk built into risk premiums. We're seeing a lot of rate risk being built in. So if we do start to see US and China tensions rise or Russia-Ukrainian tensions rise, that risk premium needs to be built in and investors need to be compensated for that.
What about the strength of the US dollar? It's been growing extremely strong lately as interest rates have risen. What kind of an impact will this have on emerging market bond investors?
I mean, the dollar weakening will be a major tailwind for emerging market bond investors, but you really need a few things to play out. The US dollar is coming off a 20-year high. That's an all-time long average when you look in its history. So once that trend does start to roll over, which we're seeing the beginning signs of it, you can be sure that that trend is going to persist and persist for a while. But the key point that we need to see play out is the growth differentials to skew away from the US in favor of the rest of the world. China and emerging market growth should help that happen.
All right, and then finally, how should an investor put emerging market fixed income into their portfolios? What kind of asset allocation should it be?
Sure, we really like a blended approach because that way you can access all areas of emerging market debt, looking at the best opportunities in the corporate space, the external sovereign space, and the local sovereign space, putting it all together and tactically allocating around. We also see people interested in a multi-asset approach.
All right, well, thanks a lot for coming on and talking about it.
Thank you. Take care.